US stocks and gold are surging to fresh record highs. The ECB looks set to cut rates in June. China's exports are much stronger than expected, and all eyes are on US non-farm payrolls tonight. That's coming up in our 5 Things in 5 minutes. And then in our bonus deep dive interview, ANZ economist Maddie Dunk looks at what's driving a divergence in the economic and budget performances of Australia's states and territories.
The current economic environment is really hurting some states and territories. In particular, if you look at somewhere like New South Wales, we're seeing that the labour market is really starting to slow there. And that's a big theme that we are seeing play out in this edition of the Stateometer.
But first, in 5 and 5 with ANZ, US stocks are up another 1% at fresh record highs, as at 4:30 Sydney-Melbourne time. Investors are enthused about what they see as the growing prospects of the Fed's first rate cut being in June. Gold surged to a new record high of over $2,170 an ounce, also on those rate cut hopes. They're weakening the US dollar too, against the yen, the euro and the Australasian currencies. The Aussie was up 0.8% at 66.14 US cents, and the Kiwi was up 0.7% at 61.69 US cents at 4:30 Sydney-Melbourne time. Meanwhile, the European Central Bank kept rates on hold overnight as expected, but with a lower forecast for inflation, and with ECB President Christine Lagarde saying she would have better data by June to make a decision on rate cuts. Here's ANZ economist Bansi Matavani from London this morning on Lagarde's comments.
One of the key messages that stood out to us from the press conference was that the ECB are now starting to discuss policy easing, and June seems to be where consensus is building towards moving on rates. The Governing Council will have more data by their June meeting, in which they will have the Q1 negotiated wage settlement data and inflation readings right up till May. So we think that the ECB is now teeing up towards a June rate cut.
Number 2, data out overnight showed exports from mainland China in January and February were better than markets expected, indicating a recovery in global trade. Here's Bansi again.
Headline exports came in at 7.1% versus market expectations of just under 2% growth. I think what we're seeing in there is the strength that we saw in Korean exports, in Taiwan export orders, continuing to reflect in China as well. In China, the strength in exports was driven by demand for semiconductor products. The integrated circuit exports rose 20% on an annual basis in the first 2 months. So I think it's important to note that while Korea and Taiwan are on cutting edge of semiconductor technology, China is still a pretty large player in the mature side of technology as well, which explains why the upturn in global tech cycle will have benefits for China. I think another trend that we noticed in the export numbers was that China's bilateral trade with emerging economies is expanding, while that with the US and the EU is sort of slowing down. Look at trade with India, look at trade with Russia, with Brazil, with ASEAN. Well, ASEAN is now the single largest trading partner for China. So we think that, China's expansion of trade with emerging economies may be its own version of friendshoring.
Number 3, in Australia, housing lending unexpectedly fell 3.9% in January from December. That's the second month in a row that new loans have fallen. ANZ senior economist Adelaide Timbrell says the fall was driven by a lack of new listings and sales, and very few new builds coming onto the market.
The latest data on housing lending and building approvals supports our housing price forecast for 2024. We think in capital cities, housing prices will rise 5 to 6% through the year. This is during a time when rates are restrictive. So what's offsetting the negatives in borrowing capacity is the mismatch between demand and supply.
Number 4, Australia's trade balance on goods was $11 billion in January, $500 million below expectations. ANZ economist Maddie Dunk says despite the softer number, there weren't too many surprises.
We saw that export growth slightly outpaced import growth, so exports were up 1.6% for the month, while imports were up 1.3%. And one of the big drivers of that increase in exports was large growth in gold exports. And non-monetary gold is something that can really swing the trade balance results around.
Number 5. Now looking ahead to the US tonight, non-farm payrolls will be crucial for Fed watchers. The consensus is for jobs growth in February of about 200,000. That is down from the 353,000 reported in January. Bunsey says the Fed will want a few more months of data showing easing inflation pressures before looking to cut in July. Markets are currently picking June as the start of rate cuts.
This report needs to show some signs of moderation in hiring for the FOMC to get the validation that monetary policy is adequately restrictive to support the sustainable return to inflation. So given the strength that we've seen in December data, in Jan data, we think it may take a few months for the non-farm payroll growth to sort of rebalance to a more sustainable level.
Bunsey Madhavani there. Now, in our bonus deep dive interview, ANZ has just published its latest Stateometer survey of Australia's state economies and finances. ANZ economist Maddie Dunk explains who's doing well and who's not.
When we look at this edition of the Stateometer, there are a few really clear standouts. We saw that Western Australia and South Australia did incredibly well. Both were seeing that their economic performance was accelerating, and it was also above their long-run average trend. In contrast, all other states and territories saw that their economic performance was below trend. And while there were signs of some green shoots in Queensland and Victoria, I think all in all, when you look at this edition of the Stateometer, it's hard to look past the performance of Western Australia and South Australia, and a lot of the momentum there is being driven by very strong housing price growth. So we've seen that over 2023, WA housing prices were really going gangbusters. So they were up almost 16% over the year. And similarly, SA housing prices have been very strong. So they grew 9% in 2023.
And what's dragging down those other states?
Look, it's a combination of things, and I think understandably the current economic environment is really hurting some states and territories. In particular, if you look at somewhere like New South Wales, we're seeing that the labour market is really starting to slow there, and that's a big theme that we are seeing play out in this edition of the Stateometer. There's been quite a big fall in the labour market component for most states and territories. There are some exceptions there, of course, but in general, things are really cooling and we're seeing that activity has softened. So if you think about New South Wales, for example, we've seen that while in Q4 their unemployment rate was the lowest in the country at 3.3%, if you look at the latest data in January, the unemployment rate's risen to 4.1%, and we saw that employment growth was really starting to soften there over the later half of the year.
And is that due to sluggishness in certain sectors that perhaps aren't being seen in places like Western Australia?
Look, I think that the WA economy has quite a lot of strengths. Obviously, we know that it's got a very strong mining sector, and that's one of the things that flows through in their fiscal position. But the WA fiscal position is incredibly strong, and it really is quite remarkable how we are seeing those surpluses in the budget position expected to continue, and a lot of that comes down to elevated commodity prices, strong mining export sector there.
Maddie Dunk there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Friday, March the 8th, International Women's Day. Catch you next week with tonight's non-farm payrolls data analysis, what that means for the global economy and interest rates. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.